What is going on, guys? Welcome to Stock Talk with Nico Kritikos. Today, we are going to be talking about why I think that the stock market is due for a correction, not necessarily a giant 20 to 25% crash or anything that lasts a year to a year and a half, but something that just lasts maybe a couple weeks, maybe a correction of, let's say, 10, 15%, something like that to pull us into a healthier valuation. So, the stock market in the last year is up 36%. Okay. If we look at the last 10 years or so of the average annual return for the stock market, we can see that the best it's been is 29%. 2013 and 2019, we had 29% years, right? And then not only that, but you also got to think about how many years in a row do you have a big consecutive gain like that. The last 2 years, we've had pretty substantial gains, 24% in 2023, and now 2024, it should be even more than that, being that it's 36% right now. So 36% a year is a lot, which means this market probably needs to come down 10%, 15% to get to a more reasonable place and a healthier place for the market, because it's not healthy for the market to just keep running up and up and up and up and nobody's selling and people just keep buying. That's not a healthy market. It creates an artificial bubble in the market, and companies' earnings have to grow and match that valuation. So that's my first problem. My second problem is that if we look at the PE ratio of the stock market right now, we can see this says a 30. Yeah, so I guess you could say it's about a 30 to 31. Okay. And as you can see, in the last 10 years, it normally trades right around a 23. Okay. And what happened last time we got into the 30s? Well, just a couple of years ago, the market had a huge crash and it lasted over a year. Now, I don't think it's going to be that bad because the valuation's not that high yet. Now, if this market keeps going and we're trading at 40 times earnings, then yeah, I would think maybe a 6 month or 9 month crash is realistic. But right now, with where we're at, I think that if we can come and trade back down to, let's say, 25 times earnings or something like that, that would be a much healthier valuation. And keep in mind too, companies' earnings are also going to be growing. So that's going to help kind of offset this a little bit. As those companies grow in earnings, then and the market comes down a little bit, that's where we get a really powerful effect as far as reaching a healthy valuation. Now, I know there's lots of positive catalysts, you could say, going out there right now. Specifically, Donald Trump being president is going to help out the economy in the United States and a lot of these companies, right? Because like last time, he cut the tax rate to where their earnings were way higher, they could reinvest into the business and all that stuff. So there's that. And then there's the fact that Trump is probably willing to cut regulations, and he's pro-business and he's pro-American business. And so he's probably going to try to help these American companies as much as he can. So that's great for those companies. Tesla's a great example of one of those companies, right? So those are very bullish catalysts, but that doesn't mean that the stock can just trade to the moon and just disregard any valuation metric. So you have to keep both of those things in mind. And I think in terms of, let's say, the next 4 years, I think it's going to be a strong stock market. But in terms of the next couple of months, the next 3 months or 6 months, we need to come down to a more reasonable valuation. So those are my thoughts on the current stock market. And thank you for watching. I will see you guys in the next video.